Eric, welcome back to F.A.C.E. Glad to have you back. It's been a while, and I know that you've been all over YouTube. So unmute and let's talk about what you're seeing on your radar.
All
How
right,
are you?
good to be back, Dale. It has been a while. It was nice to catch up with Blake a couple days ago.
Yeah.
It's
So,
good to talk to you, Eric.
When we first started doing interviews, I don't think you were as well known as you are now. You've
No,
really grown. Your
yeah,
following and footprint.
the traction that we've been getting has definitely increased. The YouTube videos have helped with that, and I certainly appreciate you giving me a platform before most people did. So I have a lot of gratitude for you.
Okay, well, we love finding diamonds in the rough, and I know the first time Blake heard you, he wanted to interview you for that site, Traders Summit, and he said he just interviewed you. So you want to skip the real estate part, and we'll get to the elephant in the room, Eric, and that's obviously this Wednesday.
Sure.
Now, if you do want to share your screen. Oh, there we go.
Yeah, I have a couple of slides,
Okay.
but let me see here. Actually, let me try and get this a little bit better
So
here.
you're showing industrial production, non-farm payroll.
Yeah. So can you see these four slides here?
Yeah.
So what I just wanted to talk about to set the stage before we even talk about the Fed is that, it's really important to define where you are in the cycle. There's a lot of debate now. We have 2 negative quarters of GDP. We may have a third negative quarter of GDP. The Atlanta Fed now cast for Q3 is like down to 0.5%. But, real GDP is not an end all be all measure. So I just want to take the time to what I feel is officially define where we are, because it can confuse a lot of people. A lot of people right now say, well, we have 2 negative quarters of GDP. We're in a recession. Well, some assets may not be reacting like we're in a recession. What gives? Is this different this time? Right.
Yeah.
And
I'd like to mention that, I interview you, I'd say every 3 months or so. It's kind of how the rotation goes. And
yeah,
you were on top of the story before people were talking about it six months ago.
And a lot of that comes from just tracking the cycle in the appropriate way. Now, nothing that I'm about to show in the next couple of slides is a leading indicator. None of that tells us where we're going. But if you can accurately define where we are right now, you have a major leg up over most people. So the cycle is not defined by real GDP, despite what most people think. And this is completely nonpartisan. The cycle is defined by what I call the four corners of the economy. But when you look at the NBER and how they date business cycles, real GDP is not a sufficient condition. You have to look at production, employment, consumption, income, all the different parts of the economy, and you can see how all of these are trending. Now, all four corners of the economy are trending lower. The growth rate is decelerating, and that's been happening for some time that we've been talking about. But when you combine all of these measures together, and you sort of aggregate them to one index, you get a much more reliable indication of where the underlying economy is actually trending. And right now, when you take the composite of income, production, consumption, and employment, we're trending at about 2.5% relative to a long-term average of 1.8, call it 2. So we've slowed considerably, but we're right on trend, basically. And I say that to emphasize the fact that we're not in a recession. We've had 2 negative quarters of GDP, but the reason that asset prices aren't responding that way is because we're definitely not in a recession right now. You can see that clearly. We're trending at about 2% growth. Now, the growth rate is directionally falling, which is extremely important, but it's not negative. It's not, zero. the reason that real GDP was weak or negative in Q1 and Q2 was because of the inventory component. Inventory was substantially negative in Q1 and Q2, and
all the retailers took it on the chin.
Yeah, exactly. And
right.
there's a measure called real final sales, which just takes GDP and subtracts out inventory. Because if you take the 10-year average of inventory's contributions to GDP, it's zero. So inventory doesn't contribute anything to GDP over the long term, but any given quarter, it could add 2%, it could subtract 2%, it can be extremely volatile. So Q3 of 2021 and Q4 of 2021 were massively overstated because of huge inventory contributions. And then Q1 and Q2 were understated because of these inventory draws. So
Eric, could we have a growth scare without having a recession?
We absolutely could. So we've been trending lower. Now the question, the real $1 trillion question, which ties into the Fed, is can the growth rate in the economy stabilize and sort of start to trend higher without going below zero? And the answer to that is, of course, it can. It's happened many times before. My view this time is that it won't. And I just want to I'll just do it much more quickly this time, but there's two other slides I want to show. Is that real GDP is the measure that everyone looks at, but not a lot of people are aware that there's a equal counterpart called real GDI, or gross domestic income. They seek to measure the same thing. GDP tries to measure the expenditure side of the economy. Gross domestic income tries to measure the income side of the economy, and they're supposed to be exactly equal. They're not. It's called a statistical discrepancy, the difference between the two of them. But it's common practice to take the average of real GDP and real GDI for a more comprehensive look. And when you do that, similar to the coincident index that I just showed, growth has been trending at 1.9% relative to a long-term average of 2.2. So again, another confirmatory measure that growth has, of course, slowed dramatically from 2021, but it's slowed to basically trend or slightly below trend. And the last one is that everyone's very familiar with the ISM index. It's a very reliable index. They have one for manufacturing and they have one for services. This is not the one that's published by S&P Market. This is the ISM PMI, which is much more reliable. And what do you see here is exactly the same thing. 50 is the expansion contraction line. That would be like 0% growth. The 10-year average is 55.7. And what has happened? We've slowed considerably, and we've slowed to basically just below trend. So all I'm trying to do is paint the picture here is that the economy has slowed considerably.
Right.
And based on the measure that you use, it's either slowed to just a hair above or just a hair below trend. But that's where we are. We're not in a recession. So the $1 trillion question is, where do we go from here?
Yeah, could we turn up here, Eric?
Can we turn up, or do we keep
bearish
going?
Everyone's getting pretty worried about the economy and the Fed.
Right. So to answer that question, we need to use leading indicators, right? We need to use forward-looking measures to tell us where we might be heading, and the Fed obviously guides that path. The Fed is
the economy fight the Fed for a while, and
it can, and
have
it
asset
has.
prices go up, and him not really being able to take the employment rate up. And the market and rates keep going up, and these markets fight it, so that he has to use overkill to finally take down the markets.
Yeah, I think that the expectations embedded in markets are already overkill. And I think that the resilience of the economy thus far, the fact that we haven't already gone into a recession, has forced him to go into overkill drive. Raising rates 400 basis points in 1 year is, sort of overkill.
As Steve would say, like chemotherapy.
So, and the way we can define overkill is sort of embedded in this chart. So it's a little bit convoluted, but what this chart really measures, it's really important. it's a blend of mortgage rates, corporate rates, and treasury rates. So it touches everyone across the economy, no matter where you sit, the household sector, the corporate sector, government expenditures. It's a blend of all of them. And what I do is I take the 18-month rolling change, and it's inverted, so it makes sense with the economic cycle. But when the line is moving lower, interest rates are rising. When the line is moving higher, interest rates are falling. And you can see here, I actually haven't updated this. We actually made a new low. But basically what this chart is saying here is that interest rates across the economy, mortgage, corporates, and treasuries, are 300 basis points higher than they were 18 months ago. That's the largest interest rate spike that the economy's had to deal with since 1980, 1981. And the problem to me, and the reason why this is going in when we look at this in hindsight a year from now, in my view, is going to be way overkill, is because when you study this chart, and I have another chart that I unfortunately bring in this deck, is that in 1999, interest rates rose about 200 basis points with debt to GDP at 270. Then it was 150 basis points of interest rate pressure at 330% debt to GDP. Then it was 129 basis points of pressure at 340%. And what do you notice here, Dale, is that as the debt levels have increased, it's taken a lower and lower amount of interest rate pressure to trigger a recession. And now we're here with an even larger debt burden, but we're
hasn't yet.
Yeah, and we're going to put 300 basis. Well, we have already put 300 basis points of pressure onto the economy. So the chances that we're able to reaccelerate and avoid a recession is extremely low, in my view, given the fact that you can see the space between the black line and the gray bar. Right? It's a leading indicator. It tells you that when rates spike really hard, 6 to 12 months later, there's going to be a major slowdown in economic activity that necessitates lower interest rates to get the economy out of it. Now, we're just pressing interest rates higher and higher and higher. And now we're 300 basis points higher with the highest debt load that we've ever had. In my view, there's going to be a little bit of space here and then another fat gray bar, because it's going to be very difficult for the economy to withstand that kind of rate pressure.
So the long bond might be setting up a decent spec buy in this kind of environment.
Hey, Dale. Hey, Eric.
Sure. Hi.
Steve here. How have you been?
Well,
one thing I know you're very well aware of, but you didn't mention in this analysis, is that there is also another huge difference in comparison to the 1980s. The maturity of the debt is extremely shorter than it was back then.
Yeah. So the based on my calculation and everything that I've read, the weighted maturity is, it's tough because when we go into private and public, to get the exact calculation, but it's roughly in the 5 to 7 year range. So what that means is somewhere around 40% of the debt load has to roll every 2 years, basically. So there's two things that factor into the analysis of how deep the recession could be. One is how high interest rates are pressed, and here we're obviously very high. And two is how long they stay elevated, because that will determine how many people have to roll into 300 basis points higher rates. And that's a little bit in question, right? So, if you flash down and flash back up, that could be, you could maybe avoid some of the nastier sides of the recession. But if you press them high, like we have now, and hold them here 6, 12 months, and you have, more and more of the economy has to roll into these higher rates, it's not too hard to see how that would impact things. And where the effect of these interest rates comes first, at least in the private sector, is the housing market. And that's another great leading indicator. So, similar to what I did with the coincident index, I like to put everything into a basket so we don't rely on one indicator. We get really a three-dimensional view of everything that's going on. And this is a basket of, the housing market index, which is a sentiment index of home builders, the MBA purchase applications index, new construction, building permits, new home sales. It's a lot of stuff. And you can see that, we had a tightening cycle in 2017 into 2018. And as soon as the Fed pivoted in December of 2018 is when the housing market bottomed. But the economy continued to slow for another couple of quarters. If you remember, the Fed was cutting interest rates in 2019 before
Yeah.
COVID, but the
after he's
housing
saying
market had already,
kumbaya with the
bottomed, right?
Yes.
So my point here is that even if the Fed pivoted today, the economy is still going to slow for another couple of quarters because of that lagged effect of the housing market, right?
So will
But
the recession hit us in 2023? I'm getting that, we're back to normal levels on a lot of your indicators. Except housing is leading the way. So for Fed policy to work its way through the economy, should we be expecting the recession to become very obvious by the spring of next year?
Yeah. So what I'm tracking in all of my data is that the sharpest parts of the slowdown are going to hit the economy somewhere between October and February of October of this year to February of next year. But you have to remember that a lot of this data is reported on a lag. So that's the window that I believe it's going to hit. But if you just shift that maybe 1 to 2 months forward to account for the data that's reported in that window, it may be something like, November to March or something like that. Because you have to remember what we're trying to capture here. Let me see if I can draw something. Can you see this if I draw something here?
Yeah.
Can you see that? If the cycle moves like this is the economic cycle, you really want to catch, this part. This is the part that causes the real destruction, right? It's when, here it's obvious that the economy is in a deep recession. You got job losses and everything like that. But that's when you want to start to try and think about going the other way. And where we are now is, we've obviously come way off peak, and we're right about here, in my view. And the next phase is when we sort of go like this, right? It's very plungy. It's very fast.
Call it what it is, Eric, an economic puke.
Yeah, exactly. And the economic puke is what takes you from, above to below, but it doesn't take you to, March of 09, right? March of 09 is when everyone on TV is saying how bad it is. You have job losses everywhere. It's a very scary time. But that's obviously what you're trying to get way ahead of. And what's concerning to me is that the conditions are at right now in place for this bigger economic decline, because, I took this housing index, and instead of graphing it as an index, I just tried to graph it as a drawdown, right? And this is, you could sort of see it going back over time. And you can see that every time that the housing market has a pullback, and this is in volumes, not price, has a pullback of about 5%, you almost always get a recession. You didn't get one in 84, and you didn't get one in 94, 95. My last premium report to my subscribers was about a 30-minute presentation outlining why we didn't get a hard landing in 84 and why we didn't get a hard landing in 94. Just to give a sneak preview of why, it's because the housing market bottomed in August of 84, and then the Fed cut interest rates 300 basis points starting in August of 1984. So the day that the housing market dropped about 5%, you had preemptive monetary easing that cut interest rates, mortgage rates fell 200 basis points, and then the housing market snapped back. In February of 95, the housing market again was down about 5%, but the bond market was already sniffing out the pivot. The mortgage rates peaked in December of 94. And then the Fed paused and started to lower interest rates in early 95. So the two soft landings of the last 50 years basically occurred because at the first sign of housing weakness, which leads the economy, the Fed did a preemptive monetary easing, which caused a very quick rebound in the housing market, a lowering of interest rates, and that kind of allowed the economy to continue chugging forward. And here we have the housing market that's down 9% instead of 5%. And instead of a quick pivot to try and get the housing market going, we're actually
No,
stepping on
they're
the
loving
brakes.
it. They're
Yeah,
loving it. They're
and we want to
successful.
step on the brakes even harder, right?
Yeah.
So
Well, he
those are the
emulates Volcker, but
conditions.
the difference between him and Volcker? Volcker
No,
did not cause the problem.
right, yeah, no, that's a great point. He sort of
So
was the
his
cleanup
name should be
mission,
Bernsker,
right?
which
Yeah,
is Burns and Volcker combined.
yeah. So the reason that I believe the chances for a soft landing are so low is because the only time we had a soft landing in the past was when the Fed did preemptive easing at the first sign
Yeah.
of housing weakness. Now we have housing weakness that's almost double in magnitude to the two previous soft landings. I mean, everyone in the real estate market can feel it. No, prices haven't, collapsed yet. I understand that, but prices lag volumes. Everyone in the housing market is feels a major slowdown in volumes, and that just ripples through the rest of the economy. And the slowdown in volumes is pretty dramatic. It's enough where it's definitely going to cause a ripple effect through all of the ancillary industries that are connected to real estate and new construction. And we're not looking to stop this. We're looking to amplify it.
What did you think about the statement from FedEx CEO?
It's very much aligned with the view that I'm outlining here, which is the economy is slowing, and the forward-looking indicators are suggesting that we're getting into the nasty phase where it's going to go from slowdown to recession, and I think that window is going to hit us in the next 2 quarters here, and that's sort of what he outlined. He would be on the front lines of this because if the housing market has slowed this dramatically, you think about all the stuff that goes into the housing market. There's a lot of supplies that need to be moved around. There's a lot of, trucking. There's a lot of supply chains. Anyone that's very in tune to, global trade would feel this first. And, FedEx is obviously very sensitive to that. So the real concerning part to me actually is that, it's almost like a recession's already baked into the cake, given how much housing has pulled back. We've never had a situation where we didn't have a recession with the housing market down this much. And given the fact that we're pressing interest rates higher still, there's a chance that this goes down 10, 11, 12%. And now we're getting into levels where we're into the, much nastier kinds of recessions. And look, it's a difficult situation, but that's where
you're
at.
Like a watchman for a lot of us here on FinTwit, and you talk about worried about the slowdown. What doesn't slow down is your very creative thinking about the economics of the world that we're living in and the way you share it. And I haven't, you remind me, I think what would be a cool icon for you, Google Tom Terrific. It's a cartoon from, do you know that cartoon?
I don't.
All right, well, Google it anyway. It's a little boy, and he's got a tin hat on, and every time he has an idea, a big puff of smoke comes out of the top. And you're a great thinker when it comes to these things that most of us feel are above our pay grade. So, and you make it understandable, buddy.
Oh, no, I appreciate that. And, we've been doing a lot of work with these YouTube videos to, take all of these concepts that I think are concepts that everyone, intuitively really does understand, but the profession of economics goes out of their way to make it so complicated that nobody can understand it and uses all these big words. And, for example, when talking about the stickiness of wages, right? Everyone just sort of intuitively understands that wages are sticky, but if you read an economics paper, they call it, downward wage rigidity. What does that mean? Right. It just just means sticky wages. Right. So what we're trying to do with these videos is kind of take all these concepts, break them down into ways that, everyone can understand with some visuals, some animations, some graphics. And at the end of the day, really just provide value to people because, these cycles are so important to track. And, just going back to what I outlined originally, this whole recession, no recession debate, I understand it's super political and, one team needs a recession, one team doesn't need a recession, but we're all trying to make money here. And, we need to understand where we are. And I think that priority number one for everybody should be to have a super clear understanding unbiased, totally objective of where we are right now, relative to trends, relative to where we were 6 months ago. And then, once you feel like you have that, then you kind of try and make a leap of, okay, is this line going to continue going like this, or are we going to sort of stabilize here and go like this? Because the delta between these two is sort of where the performance and asset prices come in. Some people believe we're doing this and they'll make one bet on assets. Some people believe we're going to make this. Only one team can be proven right. It's not a something that's a welcomed forecast for people, but my view based on leading indicators is that we're going to do something like that. And that to me, just to give everyone a quick takeaway means that you should really be erring on the side of defense. It's difficult for me to give a perfect prescription.
It's not return on capital, it's return of capital.
Right. And it's could be a little bit easier now because you got some 1-year paper yielding 4.1% now, which is like, hey, that's kind of something, right?
Yeah.
When was the last time we had 1-year treasury bill at 4%? So that'll certainly mop up some liquidity.
So be a saver and be aware and prepare.
And
that's your message, buddy.
Yeah. And one comment I'd like to make, just feel like throw this out there. It's a conversation that you guys can kick around because, I think we're running out of time here, or maybe for the next one. I personally believe the Fed's making a mistake here. I think that the problem that we're dealing with is a problem of excess liquidity, right? It wasn't a problem of low interest rates for too long. We had 0% interest rates for 10 years and we didn't have inflation, right? It's really a problem of excess liquidity. So I think the Fed is making a tremendous mistake by hammering interest rates to 4.5%, which is the expectation now. Yeah. And I think they would have been much better served to raise interest rates to something slightly past, what the estimate of neutral is, which most people think is about 2.5%. So I think they would have been better served to raise interest rates quickly to something like 3.25%, and then did work on the problem, which was liquidity, by unwinding the balance sheet and focus on that. I think that hammering interest rates to 4.5% when the problem is one of liquidity is something that's just going to cause a massive hit to the economy and not really tackle what the problem is, right? We're going to hammer interest rates to almost 5%. We're going to cause damage everywhere, but there's still going to be this huge mountain of liquidity out there. It's kind of a mess. So I think they would have been better served to raise rates to about 3 and then just sort of really vacuumed out as much of this liquidity as possible.
Or how about this, Eric? They intentionally want to wreck the economy so they could implement the central bank digital currency.
Well, that's certainly a possibility.
I got a little laugh out of you on that.
That's certainly a possibility. I mean,
does it make you nervous that central bank?
Does. Yeah, that does. That does make me very nervous.
All right, that was a nervous laugh.
It was a nervous laugh. Yeah, it was a nervous laugh.
Hey, thank you so much, bro.
All right,
you're the best.
Thanks, Dale. I appreciate it.
Follow Eric at EPB Research. That the best place? You want to show your website?
You could follow me at on Twitter at EPB Research. Let me see if I could show my screen here.
And check out Tom Terrific, buddy.
Tom Terrific.
Tom
so
Terrific.
If you
Google it. Yeah.
There it is. EPBMacroResearch.com. You could go, you could learn, just click this big black button here, it's totally free. It takes you right to my my framework where I kind of dig into details about my whole process. And if you're interested in the research that I publish on a monthly basis, just click that premium service. The basic package is what I provide for people. You get a monthly update. But the framework is a good place for everyone. I kind of just outline the whole process from start to finish. So I greatly appreciate the chance to share it on your show, Dale. Thank you.
We're a fan, Eric.
Thank you.
All right, buddy. So tread lightly. You just heard Eric. Get ready. And I concur. So it doesn't matter what I think, but Eric's smart and appreciate you today, man. So you could join the team in 15 minutes. I'll just reiterate what Blake said. We do great work here, and prices are going up I think the end of this month. So last chance to jump on current rates. Did you hear that, Eric? You better subscribe because our rates are going up.
The time is now. Today's the day.
Today's the day, buddy.
Today's
All right,
the
Eric.
day. Yeah.
Take it easy, man.
All right. See you guys.
All right, bye.
Bye-bye, Rick.
Bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.